overhang of the economic situation we're in today. What does it mean for central banks? What does it mean for the value of money? What does it mean for monetary and fiscal policy as we move towards a world of central bank digital currencies? These are some of the biggest changes we've ever seen. So that's one thing. So that obviously brings me into the bullishness that I have for things like Bitcoin and gold. I'm also very interested in the technology within the blockchain space and the disruption of that and a new financial system that's emerging, and that gets me interested in the whole digital asset space. But at a simpler level, we are at the final stages of a very big and long dollar bull market. I think the dollar may go up further, but it's long in the tooth now, this dollar rally, and it's been a problem for the world. It's sucked in all of the capital to the United States. It's been a problem for many countries. When the dollar turns, which it will do properly over the next couple of years, it changes the investment outlook, which has been the US over everything, and becomes everything over the US. So you'll find a huge growth in emerging markets coming forwards over the next 10 years. If the dollar is weak or just not so strong, buying emerging markets and going to the beach is as good a strategy as you need for asset allocation anywhere. Don't forget, we're stuck in a world where there's no bond yields anymore. Credit doesn't work any longer because the Federal Reserve don't allow the pricing, and same with the ECB, the pricing of credit. So you're left with equity markets at all-time record valuations, or you can go and find markets that are cheaper, that have better demographics and less debt, which I find very interesting abroad. So those trends are there. The trend of technology overall, software eating the world, is a trend that's not going away either. And business model after business model is getting destroyed by software. Finance happens to be the big one right now. So a lot going on in the world, a very interesting 10 years ahead of us.
Yeah, okay, so let's run through these. So monetary policy, new monetary policy regimes, the dollar weakening, low yields, and the rise of technology. Let's touch on all of them, but first let's talk about the dollar. Now, you said that the dollar is in a secular decline, and I know in I know in your work you've discussed that the amount of dollars circulating in the world is not proportional to the US percentage of GDP that occupies the world GDP. Can you explain this differential? Why is it that the US GDP is not, 80-90% of global currency circulation, but the US dollar is somewhere around there?
Yeah, so we have been in a secular bull market. I'm still not decided whether it's ended yet, but there's a problem, and the other central banks talk about this a lot. If you read any of their statements, is the US is 25% of world GDP. The US dollar accounts for 80% of all transactions on Earth. So either the US has to keep printing huge amounts of money, or everybody needs to create dollar credit through the euro-dollar funding markets, through the credit markets overall, or there's not enough dollars. So what happens is when you have these economic downturns, you often get a very strong dollar. And we saw that in March because there wasn't enough dollars in the system. So the world is struggling with this dollar system. The SWIFT payment system is the network which operates everybody's cross-border payments. That's a US thing. People are also geopolitically less comfortable. China, for example, is not so comfortable. Even Europe's less comfortable with it. So we've got this big issue where there's really not enough dollars for this whole global financial system to operate in. And it's hard for the US because it needs to run massive current account deficits and huge credit and keep injecting dollars into the market. That feels like that's going to change over time. And the IMF have talked about this, and others have as well. Mark Carney at the ECB, when he was there, is they're talking about maybe creating a basket of currencies to create a global currency where the dollar is part of that basket. And its weighting will not be 80%. It probably won't be 25% either, but let's call it 45% of the basket. So the dollar's impact on world trade goes down. It's too hard for countries like South Africa, Brazil, etc., to deal with the dollar going up and down and it affecting their exports all the time. That needs to change.
A lot of the economy is ingrained deeply in the US dollar. Oil is traded in dollar terms. Some currencies around the world are pegged to the dollar. How could the dollar evolve into a non sort of global default de facto currency, what could possibly take its place, Raoul?
Well, what I think is taking its place is there is nothing to take its place. But if you create a basket of currencies, this is what Facebook talked about with their Libra idea, that the global regulators immediately said, no, don't do this because it's too powerful an idea, which was to create a basket, a trading basket. So let's say you're South Africa and I'm China. We can trade with each other using global currency that has dollars in it, it has RMB in it, it has another bunch of currencies. Now, if the dollar is in that basket, then its denominator is probably money supply of all of the currencies in it and not US dollars. So it becomes much more stable. Now, the US doesn't mind that because it stabilizes trade for the US too. As long as the US doesn't lose reserve status overall, this way it's kind of enshrined that it has, let's say, 45% of reserve status. So it's not too much and not too little.
When you're looking at monetary policy and global growth, the US Federal Reserve is not the only central bank that has an accommodated monetary policy. Everybody seems to be on a race to the bottom. And so when you're looking at the differentials here, who has more of an accommodated policy, and where would you allocate your capital if you had to decide between domestic equities or foreign emerging equities?
Well, I mean, this is the big question. I mean, because it's a rolling process. Is the Europeans stimulate, and then the UK stimulates, and then Japan stimulates, and then the US stimulates, and it moves around, which is why a lot of these currencies have actually been in quite a big range over time. They actually haven't moved a lot. And maybe that's the status quo. Maybe we're at the bottom end of the range and the dollar rallies a bit from here because maybe the Europeans have more to do right now. So it's not really clear where the opportunity lies. But let's assume for a second that we're not going to go into a dollar secular bear market or bull market. Maybe it's like Japan, where the currency trades in a sideways range for a long time. Well, if that stability is there, then emerging markets do extremely well, because all they need is the dollar to stop going up and they start to outperform. And we've seen that recently as the dollar's weakened over the last 6 months. Emerging markets have all risen. I've constructed a framework of the world based around debt and demographics. So I put up a map of the world, took out every country with aging demographics, which is the whole Western world plus China. I then took out every country with high debts. And what you're left with really is a world around the Indian Ocean, with India at the center of it. They are much cheaper. They have populations under the age of 30. They have all the natural resources that they need. They have the intellectual brain power, and they've been trading with each other for millennia.